The US-China trade war has heated up to the point where possibilities of agreement are declining quickly.
Somewhere at the very start of the year 2019, we all believed that this conflict may come to an end soon. But regrettably, the war is becoming worse. As a matter of fact, if the war continues, businesses in Europe, Mexico, Japan, and Canada may receive extra export orders worth tens of billions of dollars.
In September 2019, the conflict between the two nations with the largest economies in the world flared up. The win-win trading model is evolving into a lose-lose situation.
And even though it harms the global economy, China and the US are decoupling. However, other components of the trade war, which ultimately led to an economic downturn in China and caused volatility in international markets, could negate the benefits for some countries. A protracted trade war may further weaken the already fragile global economy by upsetting global supply lines, driving up the price of commodities, and upsetting the financial system. This has issued a warning that trade hostilities might escalate into currency wars and that additional nations might enter the conflict by enacting their levies. Furthermore, the trade conflict between the US and China, two major economies, causes concern for other countries. Both countries constitute significant global markets for goods. Therefore, their tariff rates and non-tariff laws may have an impact on consumers and companies around the world. So if you think for a second, who's benefiting from the US-China trade war? Then it's certainly third-party countries with deep connections to international partners. Many countries are benefiting economically from the trade conflict, even if it is costing them greatly in commerce. Here are some countries that stand to gain from the trade conflict between the two economic giants.
Number 1, Vietnam. Given its cheap salaries and lax labor and environmental restrictions, the nation has been dubbed the New China, and it may be ready to increase its exports of manufactured goods to the American market. Many businesses have moved their operations there in recent years, and 2019 has already seen a 34% increase in U.S. imports from Vietnam.
Vietnam is a consistent economic leader that is highly affected by the trade war, although this is in a positive way. The International Trade Center estimates that Vietnam's exports increased from $176.6 billion in 2016 to $290.4 billion in 2017.
According to the U.S. Census Bureau, Vietnam and the U.S. have a $39.5 billion trade deficit, which is to Vietnam's advantage. In simple terms, Vietnam is coming out on top in the trade conflict between the two significant economies.
Since the beginning of the economic hit between Washington and Beijing, analysts from the Japanese investment bank Nomura have discovered data suggesting the two countries have reduced their purchases of specific products from one another in order to avoid higher taxes. The economists stated in a research presentation that importers in the two countries have instead been acquiring identical products from alternative places not subject to tariffs. According to Nomura, Vietnam has so far appeared to be the country that has benefited the most from the change in trade flows, with an estimated 7.9% increase in its GDP as a result of the new business. Number 2, Mexico.
Mexico is another country successful in the trade hit between the US and China. Mexico surpassed China this year to overtake China as the US's top trading partner. The U.S. favorable trade deficit with Mexico was $81.5 billion in 2018, up 14.9% from 2017, according to the Office of the U.S. Trade Representative. According to the Census Bureau, Mexico benefits from the $9.9 billion trade gap between the U.S. and Mexico. According to the Office of the U.S. Trade Representative, the trade in goods and services between the U.S. and Mexico reached a total of over $671 billion in 2018, making Mexico's America's third largest trading partner.
Additionally, if the revised North American Free Trade Agreement is approved, it might help Mexico's exporters even more. Number 3, Chile.
Chile is an open emerging market that accounts for 86.3% of the global GDP. In fact, it has trade agreements with 64 other countries around the world. According to Finance Minister Felipe Larraín, the nation has intended to respond to US-China trade by opening even more markets in order to set up itself as a global economic hub. He claimed that although they are dealing with a trade war and a complex international situation, they're handling it better by being more transparent and providing easy access.
Nomura reported that Chile is increasing its GDP by 1.5% as a result of trade diversion. The Andean country's largest trading partners are the US and China. Due to their significant investments in Chilean businesses and their importation of Chilean goods, both of these nations are essential to the economy's operation.
This is made worse in industries like mining. Chile is home to Escondida, the largest copper mine in the world, which supplies 5% of the world's copper. Chile produces 30% of the world's copper, which accounts for 20% of the global GDP and 60% of mining exports. Approximately 50% of all exports are currently related to the mining industry.
The sales of this metal reached 20% to 25% of the fiscal income in recent years when the worldwide prices were high and were referred to as the salary of Chile. But since the trade war began, copper prices have fallen rapidly, leaving Chile's very vulnerable economy at the whim of the US and China. Number 4, Taiwan. Taiwan had the biggest increase in sales of office and communication devices. A little over 2.8 billion of the total amount was made up of office machinery and technological equipment. Because of its developed tech sector, which has access to plenty of local talent and long-standing economic relationships with China, the island rose to prominence as a manufacturing powerhouse decades ago. Today, it is taking a disproportionately large amount of diverted capital. Before the trade dispute started, a number of Taiwanese companies were already moving their activities back to Taiwan from China. The self-governing island can see a business opportunity in the US-China trade conflict. The economy of Taiwan has improved, according to the Economy Ministry. Businesses plan to rearrange their worldwide supply chains owing to the US. China trade spat during the peak season for demand for digital products. According to Nomura, the trade conflict is increasing the nation's GDP by 2.1%. 2019 will see Taiwan surpass other Asian nations with the quickest growth. Many of the same electrical products that China produces are exported by this Asian tiger. Despite higher wages in this country, tariffs on Chinese imports probably make Taiwanese goods more competitive.
US imports from both countries are increasing, according to 2019 trade figures. Number 5, Malaysia.
Malaysia is ready to embrace Chinese companies to strengthen its economy. Manufacturing enterprises are expected to boost the development of the country's economy by an additional 0.1 percentage points.
Due to increased US tariffs, manufacturers with operations in China are looking to relocate, and Malaysia is one such country. A contract to move 1.62 million tons of palm oil to China for $900 million has been struck. According to an Asian Development Bank assessment, 82% of Malaysia's largest companies and close to half of a small and medium-sized businesses participate in global value chains. According to Nomura, the US-China trade war is increasing Malaysia's GDP by 1.3%. Electrical and electronic goods, rubber goods, scientific and optical devices, wood products, and other manufacturing goods made up over 80% of Malaysia's exports to the US. Items related to electricity and electronics, chemicals, industrial machinery, optical and scientific instruments, and steel items made up about 76% of US imports. According to the MITI, Malaysia's businesses with China increased by 0.3% to 149.16 billion from January to June 2020, compared to the same period in 2019.
One hypothesis is that countries considered the trade conflict as an opportunity to increase their market share on a global scale. Due to its zero-COVID policy for the past few years, China experienced difficulties in its trade business. Countries had the chance to make investments in more trade prospects or to engage larger segments of their workforce as a result of these trade imbalances. These adjustments allowed countries to boost exports without hiking prices.
In the long run, will there be any winner in the US-China trade war? We'd love to know your thoughts in the comments section. If you enjoyed this video, make sure you click the like and subscribe buttons. Most importantly, don't forget to click that bell icon to be notified when a new video is uploaded. Also, feel free to leave a remark if you have any recommendations for videos. From No Cap Capitalist, have a great day everyone, and thanks once again.